Good morning, Stocktwits Nation. What's going on? Good to see you all. It is Shay and myself here today. Katie will be joining us shortly. But yeah, we've got a busy morning in the markets and a lot to talk about. So she'll pop in a sec. But Shay, how you doing?
Doing well. Recovered from the one bad red day we've had in the market in a while. It's kind of crazy to see the bears come out whenever they get even a glimpse of opportunity to tout their chests. They've had a really tough couple of years, but yesterday when the indices are down like maybe 1.5% Qs, growth was significantly down. There's some names that are above more than 8%. They're just touting just like how they were right. It's just crazy how it happens every cycle. But clearly the market's profit taking ahead of Jackson Hole's speech on Friday.
And what was kind of the big issue in tech? I think I saw a report that like 95-ish from MIT, I think 95-ish% of like AI related, tools being used by companies are not kind of providing the boost that they thought it would. So I think there's this general kind of re-rating of AI right now where people are scared once again. But then on the other side of it, you have companies like Meta, Microsoft, Amazon, all the Mag 7 investing hundreds of billions of dollars per year. And that's not going to shut off on a dime. So do you have any thoughts there about that report or just in general about why people are concerned about AI now?
Yeah, I think it's just normal FUD. You saw proof in the pudding that last cycle on why AI is such an ROI. Hey, Katie, why AI is such an ROI for like the Microsofts, the Metas, like Google's. Like these were insane earning beats on the bottom line. So this is a margin expansion opportunity for a lot of these companies. I think I've talked about the AI tsunami. That's very real. We're not there yet, but typically right now, I think what's happening in the market is FUD gets generated pretty quickly and spreads like wildfire because we're in a season of weakness. We're in the part of the cycle where sentiment is really fragile. We have liquidity that's very thin. We're still in August. And every sell-off, like the one yesterday, feels exaggerated when SPY was down 0.5%. But it felt much worse than that when you saw the sentiment online, when you saw a lot of these growth themes pull back. So I do think that this kind of tape doesn't just flush out a lot of the weak hands. It does set up some opportunities. I think that the SPY, I would like the SPY to go down like a little 5-ish more percent before we hit that new all-time highs. Like I do believe that we're not going to be in a bear market. I think that what you're seeing yesterday in the headlines is just pure FUD, shaking out the weak hands. The earnings validates that AI is still the main event, and that provides a very high floor on the stock market. Black Swan is to see if Palo cuts rates in September. If he doesn't, there is somewhat of a re-rating in the market. And that's what I'm betting on as that 5% correction.
Nice. Welcome, Katie. How are you?
Hi, guys. Sorry. I'm a couple minutes late. I literally slept through my alarm. So I can't believe I can't believe that hasn't happened before because I can really sleep. But Tom, it's good to see you. Good to see you, Shay. What did I miss in the last 4 minutes?
Oh, no, nothing. I just introed the show, not as well as you
Amazing.
typically do, and we were talking about the AI sell-off and just generally what's happening with the market.
Yeah.
If I could, I have this cool tweet from Heisenberg on Twitter. If Keith could pull that up. Basically, he was pointing out that the VIX has touched 20 or higher at least once in 12 of the last 13 months. And the one that missed was like 19.94. So basically, the VIX hits 20 every month for the last year plus. And so maybe yesterday was the start of this sell off that, we get the VIX from 15-ish where it is now. We get a pop to 20 plus, and maybe that's the shakeout we need to kind of reset sentiment and all that. So, yeah, a lot of interesting stuff happening in the market right now, but definitely a lot of jitters as well.
Yeah, what's the tone in the community, Tom? I know Shy, I saw also on FinTwit people were freaking out a bit. Were you saying that was kind of overdone a bit?
Yeah, I think we're just in that part of the cycle where, like I mentioned, like seasonality is a major weakness and liquidity is very thin, that it doesn't take much to move the market. And when you see a lot of these winners pull back all at once aggressively, people are like, oh, I want to hold the bag and I don't want to be rug pulled circa 2021. We're so not even close to that circa 2021, guys. 2021, that whole move was multiple expansion due to money being free. Right now, a lot of the winners are winning on super cycles. They're not government made reasons on why that we're catching a bit. So I think that yes, there's some hot pockets, some buckets of wow, that valuation is ridiculous, but nobody knows the ceiling on AI. Every quarter, it keeps getting higher and higher, and I truly do believe that it's an indefinite demand for AI. It's not like the .com era. I think it's so much more than that. Like .com era is very product based. Same with cloud, product based. This is behavioral change where it's going to touch every part of the world. So I think that have the dry powder. I've been saying have that dry powder ready, have that conviction. Let's say you want exposure, and when we get that pullback, I don't even think yesterday was a pullback. I think it was just a slip, just a little slip. Like I think there might be more pain. I want more pain. I want SPY at 600. Like I want SPY maybe testing the 50-day moving average at 592. That's when I'm going to start allocating a lot of my cash. But right now, it's just the beginning of something far greater. And also, like when you have a name like Palantir going down almost 20% in a week, that's a new behavior. And that's usually when winners pull back that aggressively, it does indicate that a top is in. Like I think the really safe argument was if Nvidia and Palantir keeps winning, their market's going to keep going up to the right. Well, Palantir is pulling back. Nvidia is not really pulling back. Maybe a little. Their earnings report is next week. Is that going to be the catalyst that pulls it back and then we carries the market lower? Maybe. I doubt it though, but maybe.
Yeah.
Go ahead, Tom. I was just going to say, interestingly, yesterday the market was down, but I was reading that there were more stocks that were up than down yesterday. So we saw like a situation where the Mag 7 and tech that's heavily weighted in the indexes was pulling back, but a lot of the other stocks were kind of holding up pretty well. So I think what I'm seeing now and what I talked about 2 weeks ago is kind of this rotation toward value, people looking for, opportunities and things that haven't quite run as much. We continue to see that in the community overall. People are still bullish, but they're being a lot more selective. And I think we're seeing that people are taking profits in winners and looking at, names that haven't quite moved for opportunities to the upside.
Well, I also think that like it's healthy. It really is, guys. Like I think that Oscar Health, United Health Group, like Novo Nordisk, like these are names, maybe a little less than Novo, but maybe actually Novo after seeing Vikings data and Lilly's data. But these are names where it's great to kind of hedge your portfolio. If you're so bullish on super cycles like I am, like having an allocation if you don't want to keep cash like I do on these like the healthcare space, because that is usually the yang to the yin. When the market's like humming, like that's what offsets it when it's not humming. Like the Dow Jones, I think I don't know if it was green yesterday, but it was much stronger than Q's. That's indicative of how sentiment goes back and forth. And maybe the moves that the summer moves they're getting profit taking and reallocating elsewhere. So look what's lagging. And United Healthcare went up 25% in a matter of like a month. So they're seeing like, oh, there is a chance when these kind of companies can catch a bid. Where's the next opportunity?
Yeah, Tom, I think you had a recent call on IHF, and we might have a clip for that. Can you talk about sort of what's going on here?
This is something that I'm just kind of keeping an eye on as a technician. This sector has been kind of hit pretty hard for the last 6, 12, 18 months, and it's now down to a level where it makes sense to start looking for some value. So from a momentum reading perspective, RSI on the weekly is most oversold it's been in over a decade. You've got prices kind of stabilizing at this form of resistance near 40, 41. And so this kind of ties into the theme of UNH, Humana, all of those names that have really been beaten down. If we could pull up UNH, I think this is.
Yeah, interesting to see. I think I'm wearing the same shirt and look exactly the same. So
it's
shout
weird
out.
to see us side by. I was confused because I was like drinking my coffee in the clip, and I was like, wait a minute, I don't have the cup.
Yeah, shout out the inception moment there. But yeah, again, this goes to the broader value theme. I did not expect the Buffett situation to drive UNH, Humana, all of these healthcare names higher by 20-30% in a couple of weeks, but those snapbacks can happen, especially when things are so extended. So I think people are. I think generally the short-term trade is probably done, but I think longer term, people are going to be looking for opportunities in healthcare and saying, hey, if we get a broader pullback, these are names that I might be adding to, especially now that Buffett and other institutions are taking positions in them. So yeah, I brought a couple other charts. I think there's some interesting stuff happening in utilities and consumer staples, but we can get into those later. So people are still looking for value, and yeah, healthcare continues to be an area they're looking.
Well, I spotted in our notes you have some thoughts on aerospace and defense, and I wanted to ask specifically about what you're seeing in those charts, but also, Shay, we haven't caught up really on that front since some of these like peace talks are going on. And I'm curious kind of where your head's at with that. I think you're thinking long-term thematics. There are trends that are reshaping defense that aren't going away, but in the near term, is part of the pullback in that sector due to the peace talks going on, or is this just part of the tech pullback?
I think it's part of the tech pullback because I think earnings season sobers expectations. And I think that when you saw like a Joby Aviation, Archer Aviation, these names, maybe a little less than Archer, but like Joby, they caught major bids heading into this earnings print, but they saw there's not much here for them to justify next leg up. It's a story. And when you're what's Joby at? Is that 15 bill valuation now? Yeah, so I think Joby was at a $15 billion valuation. It's pre-revenue. I get that like what they're building is the full stack above the sky in a similar fashion that Tesla's doing. And it's not just an eVTOL player. There's a defense component, there's a commercial component. We had the president on our show just a week or two ago. But for it to go from 15 to 20, 25, what is going to be that driver? When you have a name like Anduril in the private markets, who everyone knows this is the age of defense player for above the sky, at $39 billion when they already make $1.5 billion. Yeah. That's a drastic valuation delta that needs to be extended compared to a Joby. Like Anduril's worth more than 2 times what Joby's worth if they already print $1 billion plus a year. When Joby won't be making $1 billion until 2029. And that is not even factoring the heavy CapEx model that's required for Joby's business when, yes, things can go very smoothly, but I can promise you guys this, going from pre-revenue to commercial scale on a heavy CapEx model, there will be bumps, there will be delays. It's impossible to have a smooth sailing for that. So I think that this is more of we got ahead of ourselves too quickly. Let's recalibrate a bit. Let's breathe a little. Like $12 billion, 12.7. Like, is that fair valuation for Joby? It's hard to say because there's no money yet. It's based on a story, what they're going to turn into. And when narrative drives the stock price, and right now the narrative and growth in the market is risk off, this is one of those names that get beaten to the aggressive side compared to other names.
Yeah. Tom, what about you? I think I spotted a chart and generally in aerospace and defense in our notes from you. What are you seeing?
Yeah, I just want to point out, like from a technical perspective, this is similar to what we're seeing in the NASDAQ 100 chart and a lot of the other leading sectors and individual stocks, right? We had massive run-ups in the case of aerospace and defense. I'm using the ETF ITA. That's up 55% in like 80 days off the April lows. We've got momentum kind of diverging. So, those who aren't familiar, RSI basically measures the buying or selling pressure. So what you're seeing is prices go up and buying pressure diminish. So technicians look at that as, waning momentum and saying, okay, this is a warning signal that a trend change could be happening. And that's exactly what we saw. ITA hasn't really gone anywhere in the last 3-4 weeks. And now we're seeing it start to roll over and resolve to the downside. And what I said to Shay earlier when we were chatting in the pre-show, Palantir, even at 150, its 200-day moving average is at $105. So it could fall another 30-40% and still technically be in a long-term uptrend, similar to ITA here. This could fall 20% and still just be at its 200-day and prior breakout area. So these things have just run so much. We're seeing some profit taking, earnings season bringing these companies back down to earth in some cases. But yeah, this is healthy long-term. If stocks were to go up 55% in 3 months consistently, we would have another tech bubble on our hands. So not quite there yet.
Yeah.
Let's talk Palantir a little. Keith, I just put the Citron post from this morning in the chat if you want to bring that up, because they doubled down on their short report. I think that's why they're kind of getting hit a bit more. And by the way, their short report is not really a short report. It's saying OpenAI is worth this, so Palantir should be worth this. It's such a different business. And now instead of saying OpenAI, they're saying Databricks. When the strength of your short report is just comparing this value against another company that's not really a competitor, what are we saying here? Like, this is ridiculous. Like right now, I get why this looks it's so misleading. Like, we're going to ignore that Databricks, which again, I'm an investor in Databricks. I own shares of Databricks. They haven't revealed this, but they have negative margins. I'm pretty sure they do. They're underpricing Snowflake on all their deals because that's the luxury of being a private company. They don't have to report on their margins. It's all about top line growth. Palantir has 40% operating margins. So when you say like, oh, it's 10%, 5% more revenue than Databricks, but they're worth four times as much, 40% operating margins. They're printing cash while growing this much. Gross margins in line. Customer count, you can't do the customer count does not make sense in this business model where one's a SaaS, one's infrastructure. One takes a ton of time to scale up. There's a white canvas approach. The other is a flip of a switch. Same reason why I was so frustrated when I saw the Snowflake and Palantir comparisons the past couple of years, because like they're completely different ends of this data intelligence world. Same thing's happening in Palantir and Databricks. And this is just today's argument. Last week was OpenAI. OpenAI is a freaking LLM, guys. The only way to make LLMs work in real world is using their AI oncology, Palantir's oncology. So it's an add-on. It's not a competitor. So this is just a classic example of they saw Tom and I were in the green room when we talked about this, where there was like a market looked a little toppy. Citron capitalized on that by picking the hottest stock that could potentially go down. That would get a lot of eyeballs. That's what's happening right now. Every 3 months, the thesis has always been for Palantir since $30. Incredible business. Valuation is low. It's been the same story for over a year, and the stock market price hasn't cared. Now it's just like catching steam because there is some like seasonality weakness right now, but like it's growing at a crazy pace. Palantir's business commercials on fire, and you can't just get out of Palantir's ecosystem. It doesn't work that way. So I think that once they're embedded, which it sounds like they're just becoming embedded at almost every major industry that wants AI, they're just going to be the operating system of AI, and it's going to stay that way. And valuation, I get it. It's ridiculous. I haven't added a Palantir since $25. Like, it's been a while for me, but I hate seeing weak short reports. I just, it's the most insulting thing in the world because they're actually telling us that we're all dumb. Like, if you actually are thinking we're going to believe what you're spitting out, which is just absolute nonsense, where you're showing this one little thing, they're showing the tip of the iceberg than the iceberg itself on why you how should value Palantir. And I just think that it's weak, and seeing the stock price down 20%, it needed to be done, but this is not the reason it should have been done.
Yeah, it is strange. I was just looking at the Stocktwits sentiment index for Palantir, and 3 months ago it was 81, and today it's 39. And there is like a sharp reaction. But I'm curious, Shay, I didn't read the report. Like, did they just not address why they picked that comparison? I guess they picked Databricks because their recent their fundraising news, but it seems what you're describing seems very odd, that they're comparing two wildly different companies in their argument for why Palantir shouldn't be valued where it's at.
Well, you know what? What's a good comparison? It's like, I'm going to write a short report. Robinhood shouldn't be worth 100 billion when SoFi is worth 27. That's essentially what they're saying. It's one's a neobank, one is monetizing attention, essentially, or eyeballs. Totally different, but they're both fintech. So what they're saying is like, OpenAI just raised a $500 billion valuation. They're like, if this is worth $500 billion, Palantir should be worth $40, which I don't even know what the valuation is for that, but like substantially lower. I'm like, what are we saying? What are we talking about here? This is like wasting mind share bits, and it's just exhausting, where it's them clearly engagement farming. And I'm pretty sure Citron shut their short departments. I didn't think they had one anymore. I thought something happened where they shuttered it in the past year, but I haven't looked into that too much. But either way, like, I smell bullshit. This is just BS.
Yeah. Well, it's interesting just to see the whiplash in how people are reacting, and how much, you know, with these reports now, and the ways things spread on social media, they get around pretty quickly. And even looking at the comments, there are people screenshotting, referencing that. So that'll be one to watch. How about we shift to some earnings from this week? We had Home Depot report their earnings, and then Tom, I know you've been sort of monitoring the housing market. So I think with Home Depot, they let me find where I have this. Hold on. They had they reported earnings yesterday, and we are watching a lot in this space because the interest rate environment could shift in September. So there could be some pent up demand, could be people waiting. But they had a pretty okay readout. What are you seeing in real estate, home building? Tom, I think you had some notes on that.
Yeah, I think generally, home building has been, the housing related stocks, whether it be home builders or, Home Depot, Lowe's, anyone that supports kind of like household formation, has been frozen for more or less the last 2 years. Interest rates are high, record prices, like home affordability is at its lowest level. Existing home sales are down. Builders are having to provide massive incentives to get people to buy new homes. And so we're just been in this kind of stuck environment where, all of the buying and the renovations and everything that was housing related happened during the pandemic. And then we had a 2-year cooling off period. If you look at the stocks of Home Depot, Lowe's, like their fundamentals are improving. A lot of that is just because of the comps being easier to beat. I mean, if you're putting up low numbers quarter after quarter, eventually you get lucky and things start to improve. But these stocks are right back toward their recent highs over the last year or two. And to me, that signals that stock market investors are expecting lower rates ahead. This is the biggest signal to me that like the market is saying, hey, you know, 6-12 months from now, we're going to have lower rates, and we're pricing that in now. And that's really the only thing that could unfreeze the housing market right now is lower interest rates. That's what's going to bring affordability in the door. You know, if we get a move from, you know, a 6.5% mortgage down to 5%, you know, that would be massive. I think every 1% change in interest rates is like $300 in purchasing power for a monthly payment in a mortgage. So from 3.25 to 6.5 where we are now, like that's a huge increase in cost for consumers. So yeah, the market is certainly pricing these stocks as if we're getting a rate cut. And I think some of the other areas that I pointed out, utilities, staples, and REITs are also pricing in some rate cuts ahead. So
yeah, what we saw at the Home Depot, they had a double miss for the first time in a decade, but they said they kept their guidance. So I think that's reflective of the anticipation of things to potentially loosen up here in a few months. We also
as I always say, it's not the news, it's the reaction to the news. It was a double miss and the stock went up. So
yeah,
that tells you all you need to know. The market is pricing in lower rates, and whether or not we get them in September or December or somewhere in between is kind of irrelevant. The market is looking 6 to 12 months out and saying, we will have lower rates, housing activity will pick up, and it will be great for these stocks.
Yeah. Well, I want to talk. I know you brought up consumer staples. We saw Target reported today. They kicked their former CEO out. They have a new guy coming in who's not even that new. This is like a Nike situation. Their new CEO started his career as an intern at Target, has only worked at Target, and it doesn't look like the market's loving that, but you got to love the story. The intern to CEO seat. The new CEO is Michael Fidelki. And so, yeah, I think the market maybe was looking to have somebody fresh in there to turn things around. They've had a rough go of it the past couple of quarters, but they are also referencing tariff pressures in their earnings readout today. I think Walmart we hear from tomorrow. Tom, on kind of these stocks that reveal sort of pressures on the consumer and consumer staples, what trends are you seeing over there?
Yeah, I think generally retail is very company specific. If you look at Guess, that's up 26% this morning. Like we said, Lowe's and Home Depot are moving higher. So it really depends on where you're positioned. With that being said, for Target specifically, this is one that people have on their radar simply because of how beaten down it's been. It's down, 60, 70% from its highs. I think it's a situation where people are looking at it and saying, hey, a lot of bad news is priced in. Eventually they'll get it right. Target is not going to go to zero. So maybe I'll take a shot at it and kind of build a position as it kind of churns at this $90, $100 level. I think a lot of the tariff specific news is still being digested. I think generally Target, Walmart, and other companies have done a good job of front running it and saying, hey, we're not sure how bad it's going to be, but we're just adjusting our guidance. We're pricing in the worst case scenario so that they can have some potential upside in the event that things aren't as bad as they anticipate. So retail, I think it's a tough place to be right now. It's very company specific, and unless you're in the details and really understanding, the trends and the way individual management teams are dealing with the macro environment, it's tough to have an edge here.
Yeah, it seems like a tough one generally, just because it's so based on trends in culture and consumer sentiment across, especially some of the apparel brands you mentioned there. Let's turn to something that is sort of dominating the headlines this morning, which was a report that came out talking about President Trump's investment in bonds. So I didn't realize this. He didn't divest his portfolio entering office. There's a lot of people looking at what he's invested in and the corporate bond moves he's made, aligning with some of the moves he's made economically. Do you think? I'm curious. There seems to be this Shay. We've talked about this, like the blurred lines between government and the private sector. You have the U.S. basically building a portfolio, and we could talk about the Intel thing. What do you make of this? Because I think there's probably a couple ways to see it. One is sort of the argument that bringing these things close together could be a positive, but then there's also the argument that things might be getting a little too intertwined, as we've seen in other countries.
I think they were gauging how much they can get away with Trump coin and Melania coin.
Yeah.
Nobody cared. And now it's like the Wild Wild West on, listen, there's no line in the sand anymore. Like, we can bend the rules a bit. And I think that's, you're seeing that where Trump, I saw the news story, like Trump is actually like personally investing in those corporate bonds. And it wasn't just normal companies. It was United Healthcare, the biggest insurance company in the world. T-Mobile, very interesting choice. I don't know why them.
Yeah.
Home Depot, all of them are a little around $1 million each. And then he also did meta bonds, which is really interesting because they constantly have issues they have too much of a monopoly, but like you're seeing Trump, the president, personally invest in their debts. So I think you're seeing a world where Nancy Pelosi, all these politicians also make these investments. Like, it's more of discomfort rather than scream like this needs to stop.
Yeah.
And usually when it's in that gray area, nothing really happens. And especially when people are in power, it's like printing cash off it. And the public isn't screaming bloody, like, wow, you can't do that. Like, they're going to continue doing so. It's awful to see because I think a lot of institutions, the reason they outperform the market or retail is because how close they are to the access of information from people actually making decisions, and they hear it directly from them. When retail has to stick their finger in the air and like figure out which way the wind's blowing. I just think that it's a little unfair. It's not apples to apples, but that's how capitalism has always been, and it's probably going to continue.
I know. When I saw that, I was like, I wonder if the new Pelosi tracker will be the Trump corporate bond tracker. We'll see. I know it's a fun signal that investors look for. And then on the other side, you have the government itself taking positions. I think I saw a report yesterday or the day before, the White House potentially seeking a 10% stake in Intel. And I thought that was interesting too, because that follows some of the other sort of big investments they've made, and they're sort of building this super portfolio. Tom, do you think that's something people in the community are looking at and potentially following when they see whether it's an individual public figure or the government itself taking positions? Is this sort of like when people are going to follow what Warren Buffett's doing when they get those reports? They're like, okay, he did this, I'm going to do this. Or is it one of the cases where it happens and it's almost too late?
That's a good question. I think generally people see it as a positive thing, right? You know, a sign of interest from either an institution or the government or an individual politician. It's just another like, like something is here. It's more of a discoverability tool than like an investment thesis. So a lot of people track these filings and transactions just to get an idea of where these important, relevant people or entities are putting their money, and then they'll use that as a starting point for their research. I don't think people are out there just buying Intel blindly based on the government or SoftBank investing. But again, if you have two major entities in the world, and you have the U.S. government heavily invested in making sure that we're onshoring chip making and all these kind of industries relevant to national security and independence, I think this one makes a lot of sense, and it kind of fits the broader theme of people looking for value and beating down brand names. I mean, Intel has been the poster child of struggling in tech, and again, if you can get another meaningful and influential party involved, it could help make that turnaround story happen faster than many have been pricing in.
Yeah, I'm curious with Intel. Do they go head to head with Nvidia, or is that one of those things where it's not a direct comp, Shy?
It's not a direct comp. I think you have to think of them as the AI factory, or trying to be. The issue with them, though, their biggest customer is themselves. Like, nobody wants to use them. It's something that is become a joking matter in the space because this is a company that should have been the US version of TSMC, and they just completely dropped the ball. And I think that for Intel, like people are like, oh, is this the old is blue? Like it's having another renaissance because it's had its best week since like February. I think they're up 20% on the speculation of the US government you mentioned, and like the SoftBank investment. But like you have to know that even with this capital and this vote of confidence from the government, Intel's real issue is still their technology. Its 18A yield is not just subpar, it's drastically lower than TSMC's. Like it's 50% and 90% for TSMC. And it has no external customers, no major external customers. And I think that you're seeing also their Panther Lake is struggling to meet internal standards. And I think their 14A CapEx is still on hold until they get a major customer to sign off. And right now, machine learning is already difficult enough. Why go for a risk of a bet on faith that Intel can solve it rather than just paying up for TSM's highly quality product, get all the highest quality tools necessary. So maybe you can actually get that AI max potential you want in your strategy. That's Intel's issue. And so I think the capital is like, it's nice. It's probably not going to change much until it's most likely going to be a government project rather than a true peer to TSMC and AMD. Let's just say that.
Yeah. Yeah, I think the other news headline, Shy, we didn't get to yesterday was Palo Alto Networks reported, but there was a leadership shakeup there as well with their one of their founders and their CTO is exiting the company. Any quick thoughts on Palo Alto and what we learned there? They had a pretty good earnings call as expected, but of course we had the founders retiring and people wondering what that means for the company moving forward.
No, it was a strong earnings report, especially when you factor in they were down, I think, 20% leading up to that print due to that CyberArk acquisition. So I think that if you want cybersecurity exposure, there are two clear tier one names in order to do that. Pure cyber exposure. It's CrowdStrike and Palo Alto. And Palo Alto showed that like their strategy, although it's not my biggest fan by acquiring tools to sell your platformization narrative, like you can't deny that the quarter marks the case that it's working, where there is some execution risk on how quickly one enterprise can position itself as the foundation of a single vendor stack. That's essentially platformization. But the numbers we saw were like I think it was like 5.6 billion in next gen ARR. That's up over 30% year over year. Bookings growth hit its highest levels in almost 3 years. So I think the question now becomes whether or not Palo Alto is going to become a major role in shaping the AI security era. I think the answer is yes. And I think the numbers prove that. However, they got it for 14% growth. I think that's why you were seeing them pay up for like a CyberArk because identity is like they're missing enforcement points. And that's what CyberArk is going to bring to the table. And I think Palo Alto is just making that bet that privileged access will become the next firewall in the agentic AI era. I think they're right. I think they're clearly seeing where the puck is heading. And this acquisition accelerates their ability to essentially double their market share from mid-single digits in identity to maybe into the teens over the next like couple years. So I think that we got what we needed from them. They're not cheap. They're not expensive. They deserve a premium compared to the Zscalers and the Rubrics in the world. And right now they have a discount against those two names. So I do think this gets a bid probably towards 220, 240. That's been my price tag on this name. But I just don't love their strategy. I never liked Salesforce's strategy in the post-cloud era. All they do is acquire BI tools because they can't innovate organically in-house. I know it's totally different games. Yeah. One's a CRM, one's cybersecurity. Cybersecurity theme is much stickier, much longer runway, but I don't like dilution. I don't like synergy risk. Maybe it's because I come from corporate strategy world. I know how difficult it is. if you continue doing this every other year, it's going to become a bigger and bigger headache.
Yeah, I think that is a fair comparable, because you're looking at two like platform models, and it sounds like when we talked about something like a ServiceNow before, they're building their platform. They've done some acquisitions, but mostly they've built that out themselves. And then to your point, Salesforce has been known to just pick up and tack things on to create the platform inorganically. But you're saying in your view, if the team is capable of expanding the platform on their own, that would be your preference.
Yeah, I think like CrowdStrike, they have 9+ modules now. That's purely organic. And I think that in the agentic AI future, we don't know what's going to be the next bottleneck in 1 year, 2 years, 3 years. It's going to constantly change because things are moving so quickly. Going through a major acquisition takes so much mental capital as well as physical capital. Like, it's such a demanding task that if you had a great R&D department or a great team that can just like innovate in-house, or a great platform like Falcon platform for CrowdStrike, like, you are so quick on your go-to-market. And in cybersecurity, in a highly fragmented area like cybersecurity, go-to-market is everything. It's the strategy you have to go to on every couple month check-in with your clients, and like, oh, like we're working on this in the back end, like we can flip a switch and just add this module to what you currently have right now. That's the upselling opportunity when you have things in-house. That's super quick. It's everything. And that's what SentinelOne, awful go-to-market strategy, great product, awful go-to-market. CrowdStrike, incredible go-to-market, incredible product. I rather invest in like one can clearly have a moat with no other help. And that's also why they have, I think, 2x the multiple now that Palo Alto has, even though it's kind of a newer company compared to what Palo Alto has been past like decade plus.
Yeah, well, cybersecurity is definitely one we'll continue to watch. It was top of mind yesterday. I was interviewing for an upcoming episode the CEO and founder of Bitcoin Depot, and they do those Bitcoin ATMs. They have like 9,000 around the world. And like the whole time he was talking, I was like, what is the cybersecurity on these things? Because this is wild. And essentially you put cash in and you pay cash to get Bitcoin through an ATM, which is nuts. So let's move to crypto for a sec. Tom, we talk about, when we talk about on the show a lot, looking at crypto metrics as a signal for where sort of the risk appetite is. You've been watching Ethereum for clues into sort of the crypto risk appetite, and then perhaps the risk appetite of the market overall. What are you seeing in the ETH charts specifically?
Yeah, the reason I'm looking at ETH compared to Bitcoin is, when we talk about risk on, people moving down the risk spectrum in the equity market, they go to small caps. In crypto, they go to altcoins. So Ethereum obviously has had a massive run. It went from under 1,500 to over 4,500 in the last 4 or 5 months. This is a very clean chart. It's basically gotten above 3,900-ish. Tried to get above that 3-4 times in the last 18 months and hasn't been able to do it. Now we are at levels where it's retesting that area from the top side, and so this should be a very clear area of support and demand. If we start to see it catch a bid here, that shows that people are buying the dip. They're believing in this breakout. They're taking more risk in the crypto market. If we see it break decisively below this area, I think it signals a deeper pullback is coming. Again, this could pull back to like 3,000 and still technically be in an uptrend. But if you want the short-term momentum to continue in the crypto market, it's going to have to be above this level, in my view. The other thing that the community is talking about is kind of the, Bitcoin and crypto being a hedge against inflation, but then we had it really serve as a source of funds when we got the hotter than expected inflation print last week. We saw Bitcoin sell off pretty heavily. We saw the broader crypto market take a dump. So I think there's this weird kind of like yin and yang situation where long term, totally, crypto is a hedge against kind of dollar debasement and inflation globally. But in the short term, it is still a 24/7 liquidity pool for institutions, for retail. And so that's what we saw last week. People taking Bitcoin and selling it on a hotter than inflation print as a way to express that they're kind of bearish on risk assets. So yeah, it's a weird kind of dichotomy, but I think clearly Bitcoin's inability to hold those new highs above 120 is showing some hesitation here from the bulls. And again, the 200-day moving average and the previous breakout area for Bitcoin is around 100K. So we could test that level and still be in an uptrend. I think long term things are still positive, but in the short term, it's definitely lost a lot of the short term momentum that has been driving this.
Yeah, there has been a lot of conversations around just overall frothiness throughout the summer and where things are now. One thing that is definitely a hot topic is that the Spack Daddy, Chamath, is back. And he is looking to do the thing again that he always does. But he basically is building a blank check company with a $250 million wager on the next frontiers of American excellence. So there's some DeFi in there, there's some AI, there's some robotics, hitting all of the main keywords. So his SPAC is the American Exceptionalism Acquisition Corp. Kind of reminds me of the My Source News opinion, whatever that was, MSNBC we talked about. But they want to list on that NYSE. They got 24 months to find a target. What do you guys think of this? Because it's interesting. We've talked about him. He gets a lot of flack. He has had some pretty solid wins, though, too. So it's interesting. People like to talk about the failed SPACs. And people getting burned there, but he's had some, if you stuck around a bit, it worked out pretty well for you. Do you guys have any thoughts on Chamath coming back into the game?
I think Spaxs left a massive stank that people are still clearly remembering, and something that's not going to go away anytime soon. I think a lot of people got burned, have trauma. Let's just say that they have trauma. So when you have trauma or PTSD, you get easily triggered when you get reminded of that time, that era. Unfortunately, although Chamath had some successes via SoFi, I think not Genius Sports, that's Nicolo's. What is it? Just SoFi? There's no way that's his only winner.
There was another. Well, Open Door.
Yeah, you got to think hard.
Open Door is down 60% still, I think, from that SPAC.
Okay.
Okay, so maybe SoFi is only there. I think there was one more. So I don't want to.
There was one more. It's driving me nuts. I'll look it up while you're.
Regardless, so Chamath is the face of the SPAC era because he became that voluntarily. He created so many different SPAC products at such a rapid pace, and a lot of them are just like shilling. They were shillers, like Space. That's what he chose. That which is just a billionaire's toy. And it's only just be rich people's toys. It's not really a commercial product. There's just a lot of like Clover's another great example. I think that he just is the face of that era, and I don't think he'll ever recover from that. So when he wants to do a SPAC thing again, he's fully aware of what he's doing. He is just not caring. He's capitalizing on the Momo. Maybe he wants to treat this as a PR stunt to improve his face in the retail community from what happened in 2021. There's a lot at play, but right now the market's looking for a reason to call a top in the seasonality weakness period. And this was a lot of ammo of how you can call a top. Like, it's a great sentiment top. If Chamath does a $250 million SPAC all of a sudden, and you're seeing these private valuations in private markets just like be insanity. And you're seeing like just a lot of like these names that aren't making any money being valued at $15 billion. It's kind of crazy, frothy times in some hot pockets. And wow, the market's definitely pulling back even more now. Palantir just broke 150. Jeez.
Yeah. On the Chamath side, retail is so over it. They do not care about this guy.
I like the meme of him like behind the tree in the yellow jacket doing...
Yeah, that's exactly what it is. And he's so transparent about it too. Like, he did a poll, I don't know, 6 months ago, and was like, hey, should I do a SPAC? And overwhelmingly everyone voted no. And he's like, dope, I'm going to do it. And then like in the risk area, he's like, retail should participate, but if they lose money, there's no crying in the casino. Like,
Yeah,
he
that's
is
crazy.
fully tongue in cheek, just saying,
It's
I'm going to do
wild.
whatever I want. And if you make money, great. If you lose money, whatever, I don't care. But like, as long as it works out for me, I'm in it. And yeah, as you can see, the returns for a lot of his previous
Yeah,
SPACs have been not that great.
It looks like
So
just SoFi based on. It's just crazy because I mean, is he just like banking on greater fool theory? He'll just find the next people who maybe weren't doing the SPAC thing in 2022 and get those guys. Because if most people are wisened up to this, it's hard to imagine him being able to get a lot of traction among retail.
Well, he made bank off those SPACs. Like, he made a lot of money. It's just retail held it back. So like, he's just treating retail as a bank, to be honest. And it's just, they all play characters. And when you become that wealthy, you become disassociated from reality a bit on like, you don't care about people or their feelings. It's just all about that bottom line P&L. This is another example of that.
Yeah, I think oh man, what was I gonna say? From a SPAC perspective, I think people know a lot more about the structure of SPACs and how the sponsors get paid. It was a huge wake-up call in 2021 where all these SPACs basically went to zero, and like the sponsors got huge payouts. They're structured in a way so that if you do a deal, almost no matter what happens with the actual company, you will make a ton of money. And so again, this retail is seeing this as a cash grab. They're like, get out of here. We don't want another crappy SPAC. I'm sure there will be traders who, take advantage of early momentum and kind of, trade it. But in terms of investors, retail has really been burned by Chamath in the past, and they're staying away.
Well, just save the mental capital, get a match, find a trash can, put your cash in that trash can, light it. Same thing. Just, it would be quicker, but same thing.
I mean,
well, at least in your brokerage account, you get the capital losses.
Yeah, it could, if you want to offset your capital gains from this year, this might be the thesis on why you would invest.
There might be better ways to do it. If anyone involved with that one wants to come on the show and explain, love to have you. And I also saw this week another company that was going through it a bit in 2022, filing to IPO. That's Gemini. That's the Winklevi twins. Gemini, if you remember, they had a bumpy patch. So some people thought the company wasn't going to make it through that patch. They endured. Obviously, they're riding this crypto wave. They're looking at some of these other Bullish in particular had a pretty breakout IPO. Was that last week? And they're looking at that and thinking, why not us? So they are filing. I believe the ticker is going to be Gemmy. But these guys continue to be like a fixture in the plot of like, I feel like millennial culture. Obviously they're the social network guys. My friends see them on Raya all the time here in New York, or at least one of them. So they're just like, they seem to be everywhere. But how much appetite do you think investors will have for, we're seeing more and more of these, whether it's crypto or crypto and stocks, these apps coming out, these brokerages. Is it just everyone's okay? I miss Bullish. I'm going to hop on this next one. Where does that end? Tom, when you see like people jumping on these things, does that excitement just continue to transfer as long as crypto's doing well?
I think it ends when earnings come around, and I think Robinhood specifically is going to have really tough comps. I mean, they've grown like crazy over the last 12, 18, 24 months. And at some point that momentum will be hard to continue on a fundamental basis. So I think, the earlier a company is to its IPO in terms of like trading activity, the more price discovery you get. So people are just trading based on expectations and what they think the company will do. Once you get that first earnings report and you get that look into how the company's actually operating and faring as a public company, that's when things tend to come back to reality. So yeah, it's fun in the short term. I'm sure they will, get solid pricing and demand, and probably see a good pop initially, but long term it comes back to earnings. And I think the environment is positive right now for their business, but it won't always be the case.
Yeah. I also saw, speaking of Robinhood, I saw they're expanding their prediction markets ahead of the NFL season. So you can now do prediction betting on NFL games there. That'll be something to watch too in the fall earnings season, how that impacts some of the other sports betting players out there. I believe the NFL is like the #1 sport in the US that people bet on. So another way to do another financial transaction in your Robinhood app, along with all the other things that you can do. Tom, who's your NFL team?
I don't watch sports at all. I'm in New York, so I guess both teams
I
suck.
love that answer.
I'm in New York, so my teams suck. So I don't watch sports. Is what I thought you were gonna say.
Yeah, I did
Yeah,
too.
I mean,
I was like,
I played baseball when I was
stuff to
younger.
do.
I
Yeah.
was a Yankee fan, but now I watch, the corn futures market and soybeans, and like I spend more of my time on that. Like, if you guys saw, at some point I will share my portfolio publicly. I'm working on like launching a blog or something, but I have some
Ooh.
weird positions open. Like, I'm long corn, I'm long General Mills, I'm long Campbell's soup. Like, it's total opposite of what Shay does in terms of growth
So
investing.
good though.
I've got a lot going on, so
Hey, you grow
Analog.
you grow beans and corn. It's the same kind of thing. It's a little different.
Yeah.
So
You're like a secret
instead of
country
betting on
boy.
sports, I'm betting on the weather and crop reports, I guess.
Tom's like listening to Morgan Wallen all day, watching corn futures, like in Manhattan. That is wild. Well, I was gonna say, if it was a New York team thing, you're welcome to join the Bills Mafia. We are technically the only NFL team in New York State proper that
True
plays
that.
there. And also, our quarterback majored in farming in college. So maybe that's
There
your
we
guy.
go.
Maybe you and maybe Josh Allen's also invested in corn futures. I
I'm
don't
in.
know. But that'll be interesting to look for on Robinhood. Of course, we have tomorrow for you guys. We're still tracking the big meeting. All the rich people are in Jackson Hole doing their gossip session. We'll get some insights from that. We have Walmart earnings, and we'll continue to watch this pullback and see if it continues. But guys, it was great chatting with you guys. Good to see you, Tom. I love seeing you quoted in every business publication all day, every day. You're really on the circuit.
The market environment's keeping me busy. I'm just
Yeah.
trying to tell the story of retail and what people are looking at and all that stuff.
All right.
If I could, one final note: as the
Yeah.
market pulls back, keep an eye on staples, XLP, utilities, XLU, and then real estate, REZ. It's like residential real estate. Those 3 areas have held up pretty well. And again, they haven't broken out yet. But I think if the market continues to pull back and we start to see rotation under the surface, these could be areas like healthcare that people are looking for opportunities. Utilities have already broken out. So if you want something with a little more momentum already, this is probably the place to look. And water utilities specifically within XLU are an interesting area. Ticker symbol PHO, I think, is the ETF for water utilities. So
all right. Follow Tom for utilities and corn. Follow Shay for the new age of defense, SaaS, AI tsunami, and all the things. You really get the full spectrum on this show. But we'll be back with you tomorrow morning at 9 a.m. Good to see you guys. And we'll see everyone tomorrow.
thanks, guys.
Thanks.